The Bermuda Triangle of property insurance may seem like a funny or an unusual title, but what I want to describe in this video are three common problems in commercial property insurance, and when all three corners of this Bermuda Triangle line up, it spells trouble for the real estate investor or owner, which I'm going to describe coming right up. Before I jump into this conversation, can I ask you to hit that thumbs up button? That'll signal to YouTube that this is valuable content. Thanks. Okay, so what do I mean by the Bermuda Triangle of property insurance? These are situations I encounter pretty often when a prospect comes to me with a building or a group of buildings, and if it goes unaddressed, any claim that occurs can be an absolute nightmare. So it's better to be educated on this to avoid these kinds of problems. Here are the top three corners of the Bermuda Triangle that concern me the most. The first problem is property values. Too often, I find commercial property insured for a figure well below what it would cost to rebuild the building today if it was destroyed. Building values should represent the 100% replacement cost value. It may be that the building limit for insurance was guessed at years ago, or it was never updated for inflation, or the building owner just wanted to not pay a lot for insurance and they decided it was better to underinsure the building to save money, figuring that they would never suffer a total loss and that if they insured it for 50% less than its actual value, they'd be okay. Today, with the cost of construction materials and labor rising over the past 2 years, it's not uncommon for buildings to be insured by 25% or more, and this is scary. The second corner of the Bermuda Triangle is coinsurance. Coinsurance is stated as a percentage, usually 80 or 90%. Unfortunately, it's often misunderstood by insureds and unfortunately their insurance brokers as well. And when it's combined with underinsurance, as I just discussed, this becomes a very serious problem. Coinsurance is used by insurance companies to encourage you, the property owner, to insure a building or other property to a reasonable value and to not underinsure it. If you underinsure a building, then you are agreeing to co-insure it with the insurance company. And in the event of a claim, you agree to also pay a share of that claim. Here's an example. Let's use the property owner I mentioned earlier who elects to insure their investment property that's worth $1 million for only $500,000. Their real estate investment property policy has an 80% coinsurance requirement. If they have a fire claim which partially damages the building, which is going to cost them about $300,000 to remediate and rebuild the building, the real estate investor thinks, no problem. I've got $500,000 of insurance. I'll get the $300,000 from the insurance company and rebuild, no problem. Unfortunately, that's not true. Due to the 80% coinsurance clause, the investor's actual recovery will be $187,500, less the deductible in the policy. The formula for figuring this out is what we call did over should. The insured did insure the property for $500,000. They should have insured it for at least $800,000, which is the full value times the 80% coinsurance limit. Assume a $10,000 deductible, and the real estate investor gets a check from their insurance company of $177,500 and pays $122,500 out of pocket as their coinsurance share to settle the $300,000 claim. Not a great result, especially compared to how little they probably saved in premiums over the years for underinsuring. The third corner of the triangle is something called ordinance and law, and it's not talked about that often, but I think it's a particularly difficult issue with buildings which could be anything more than 25 years old or older. Let's use an example here as well. You own an apartment building that has 25 units and it was built 50 years ago and it suffered a significant damage due to fire and smoke. Let's assume the building value is $5 million and it was insured for $5 million. Everything sounds good, no problems, right? Well, you go to apply for a building permit and the building department says that because of the level of damage that occurred, you now need to upgrade to the building codes and standards of today. Now that may mean the building must be sprinklered, have fireproof doors, must be ADA compliant with elevators and ramps, and so forth. You think, great, I'll get these upgrades with the insurance proceeds. Unfortunately, your insurer will not pay for those upgrades unless you have ordinance and law coverage, sometimes called O&L. The insurer's obligation is to replace damaged property with similar new property, not to upgrade it. And these upgrades could be costly. like hundreds of thousands of dollars to millions of dollars costly, and they're going to come out of your pocket. So for real estate investors, that's the big Bermuda Triangle issues we often see. But to be honest, there are several other issues to be aware of that I'll go into further details on in other videos, and includes valuation clauses, deductible structures, insufficient business income protection, otherwise known as loss of rents coverage, equipment breakdown, and something that is becoming more and more prevalent to talk about is flood and earth movement coverage. Thanks for watching. I hope you found this helpful. If so, give it a thumbs up. Thanks.